The Actuarial Risk Management Core Principles Syllabus. The aim of the actuarial risk management subject is to use the technical and business skills learned in the actuarial statistics, actuarial modeling, and business subjects, combining them with new material on how the skills are applied to solve real-world problems. The course provides the essential knowledge of risk management techniques and processes required by all actuaries, and it is an essential introduction to enterprise risk management, subject F106, and the Chartered Enterprise Risk Actuary qualification. So the course also underpins the F100 fellowship principles and the F200 fellowship application subjects, covering essential background material that is common to a number of specialisms. So the competencies: on successful completion of this subject, a student will be able to understand strategic concepts in the management of financial institutions and products. To understand concepts in the management, understand strategic concepts in the management of financial institutions and financial products. Understand strategic concepts in the management of financial institutions and financial products. Understand the risks faced both by individuals and groups who might affect financial products and also by the providers of such products. And then explain the principles and techniques used to manage these risks. And understand the key techniques used by the providers of financial products to ensure that promised liabilities can be met, and apply this knowledge together with the skills learned from other subjects to analyze the issues and formulate, justify, and present plausible solutions to business problems. And then there's links to other subjects. So now we moving to key syllabus objectives. All right. So these are the topics. These are the syllabus topics. There's 14 of them. We have actuarial advice, meeting the needs of stakeholders, the actuarial control cycle, risk governance, risk identification and classification, risk measurement and monitoring, responses to risk, capital management and monitoring, the general business environment, specifying the problem, producing the solution, living with the solution, monitoring, and principal terms. And then these all have their weightings. Weightings range from 2.5% to 30%. So a lot of the topics are weighted at 2.5%, and producing the solution is weighted at 30%. Right? And then the skills level. The use of a specific command verb within a syllabus objective does not indicate that this is the only form of question which can be asked on the topic covered by that objective. The examiners may ask a question on any syllabus topic using any of the command verbs defined in the document, command verbs used in the associate and fellowship written examinations. Questions may be set at any skill level: knowledge, the demonstration of a detailed knowledge and understanding of the topic; application, which is the demonstration of an ability to apply the principles underlying the topic within a given context; and high order questions, which involves the demonstration of an ability to perform deeper analysis and assessment of situations, including forming judgments, taking into account different points of views, comparing and contrasting solutions, suggesting possible solutions and actions, and making recommendations. So in the subject, the approximate split. Okay, let me skip to the detailed syllabus objectives. Number one, we have the actuarial advice. Number one, we have the actuarial advice. So under actuarial advice, they say identify the clients that actuaries advise in both the public and the private sectors and the stakeholders affected by that advice. Describe how stakeholders other than the client might be affected by any actuarial advice given. Describe the functions of the clients that actuaries advise and the types of advice that actuaries might give to their clients. And then explain why and how certain factual information about the client should be sought in order to be able to give advice. Explain why subjective attitudes of clients and other stakeholders, especially towards risk, are relevant to giving advice, and then distinguish between the responsibility for giving advice and the responsibility for taking decisions. Discuss the professional and technical standards that might apply to actuarial advice. So I have prompted ChatGPT to give some content for these syllabus objectives. I just want to go to that chat. So fundamental concepts. So my prompt was, what would the fundamental concepts to focus on be given the syllabus objectives? So so for exam purposes, all of the syllabus objectives roll up into a smaller number of core ideas. If you understand these fundamentals, you can usually handle almost any question set from this syllabus objective. The fundamental concepts to focus on under actuarial advice. Actuarial advice is about serving a client within a wider stakeholder system. Okay, let me phrase it differently. Or let me open a new prompt. Okay, let me open a new chat. Hey ChatGPT, please give more content on on these syllabus objectives. Focusing on their fundamental objectives. Is it fundamental concepts of fundamental objectives? Focus on fundamental concepts, focusing on their fundamental concepts. Key takeaways. How these apply in practice. Give practical examples in a South African context. Explain in paragraph formats in paragraph format, no bullet points or list, just flowing paragraphs. No bullet points or lists, just flowing paragraphs. All right, so here's the response. Actuarial advice is fundamentally about applying quantitative judgment to real world financial and social problems faced by organizations, while recognizing that these problems affect people beyond the immediate client. In practice, actuaries advise a wide range of clients across both the public and private sectors. In the South African public sector, clients include National Treasury, the South African Reserve Bank, government departments and public entities such as the Government Employees Pension Fund or the Road Accident Fund. In the private sector, clients commonly include life insurers, general insurers, medical schemes, pension and provident funds, investment managers, banks, and large corporates. While the client is the organization that commissions the work, the advice almost always affects broader stakeholders such as policyholders, fund members, taxpayers, employees, shareholders, regulators, and in some cases, the wider economy. A key takeaway is that actuarial advice is rarely neutral in its impact. Even technically sound advice can have significant distributional and social consequences. Because actuarial advice influences decisions with wide-reaching effects, stakeholders other than the client are often directly or indirectly affected. So, for example, when an actuary advises a retirement fund trustee, board on contribution rates or benefit charge changes, the immediate client is the board, but the outcomes affect members' take-home pay, retirement adequacy, and the employer costs. In a South African context, advice to taxpayers, advice to National Treasury and on public sector pension sustainability affects not only government finances but also taxpayers and future generations. Similarly, actuarial advice on medical schemes pricing affects members' affordability of healthcare, health providers' income, and regulators concerned with fairness and solvency. Understanding these stakeholder impacts is essential because professional actuarial practice requires awareness of potential conflicts, fairness considerations, and unintended consequences, even where the actuary's formal duty is to the client. So the functions of actuarial clients shape the type of advice actuaries provide, right? Insurers exist to pool and price risk, manage capital, and remain solvent while delivering promised benefits. So actuaries advise on premium setting, reserving, capital requirements, and product design. Retirement funds exist to provide long-term income security. So actuaries advise focuses on funding levels. So actuarial advice focuses on funding levels, contribution adequacy, benefit structures, and investment strategy. In the public sector, government clients often seek advice on policy design, long-term fiscal sustainability. In the public sector, government clients often seek advice on policy design, long-term fiscal sustainability, and In the public sector, government clients often seek advice on policy design, long-term fiscal sustainability, and intergenerational equity, such as evaluating social security reforms or public pension liabilities. Across these contexts, actuarial advice blends technical calculations with judgment, balancing financial sustainability, fairness, and regulatory compliance. A practical South African example is advising a life insurer on whether a new risk product is viable under local mortality trends, regulation by the Prudential Authority, and the competitive pressures of the domestic market. Sound actuarial advice depends critically on obtaining accurate and relevant sound actuarial advice depends critically on obtaining accurate and relevant factual information about the client. This includes data on membership profiles, claims experience, financial statements, governance structures, legal obligations, and operational practices. Without this reliable data, even the most sophisticated models can produce misleading results. For instance, advising a South African retirement fund without understanding its membership age profile, salary progression, and withdrawal behavior could lead to incorrect funding recommendations. So, actuaries therefore have a responsibility to ask the right questions, challenge incomplete or poor quality data, and understand the client's business context. The key concept here is that actuarial advice is only as good as the assumptions and data underpinning the advice, and professional skepticism is important, right? So beyond factual information, subjective attitudes, especially towards risk, play a central role in shaping appropriate advice. Different clients and stakeholders have different risk tolerances, time horizons, and priorities. A conservative retirement fund trustee board may prioritize stability and capital protection, while a younger membership base may be willing to accept higher investment risk for long-term growth. So in South Africa, this is particularly relevant given economic volatility, inequality, and varying levels of financial literacy. Actuarial advice that ignores these subjective factors may be technically correct but practically unworkable. Understanding risk appetite helps actuaries frame recommendations that align with the client's values and constraints, such as advising a cautious medical scheme to build stronger reserves, even if this results in higher short-term contributions. A crucial professional distinction is between the responsibility for giving advice and the responsibility for making decisions. Actuaries are responsible for providing clear, objective, and well-reasoned advice, including explaining the risks, uncertainties, and alternative options. However, the final decision remains with the client, such as the trustees, the board, management, or government official. So, for example, an actuary may advise that a pension fund is underfunded and recommend higher contributions, but it is the trustees who decide whether to implement those recommendations, balancing affordability and stakeholder pressure. So, this distinction protects professional independence and ensures accountability, while also highlighting the importance of communication, since poor explanation can lead to poor decisions even when the technical advice is sound, right? So, actuarial advice is governed by professional and technical standards that ensure equality, consistency, and public trust. In South Africa, actuaries must comply with standards issued by the Actuarial Society of South Africa, as well as international actuarial standards and relevant legislation such as the Pension Funds Act and insurance regulations under the Twin Peaks framework. These standards cover areas such as data quality, modeling, reporting, communication of uncertainty, and ethical conduct. So the key takeaway is that actuarial advice is not just a technical exercise, but a professional one, right? Requiring adherence to established standards to protect clients, stakeholders, and the public interest. So these standards help ensure that actuarial advice contributes to a stable, fair, and sustainable financial system in South Africa. So that was actuarial advice. Actuarial advice, and then meeting the needs of stakeholders. Meeting the needs of stakeholders. Meeting the needs of stakeholders. Describe the main providers. So these are the core syllabus objectives. Meeting the needs of stakeholders. Here we have to describe the main providers of benefits on contingent events, describe the main types of social security benefits and financial products that explain how they can provide benefits on contingent events which meet the needs of clients and stakeholders. Explain the main principles of insurance and pensions that impact on these benefits and products. Describe the ways of analyzing the needs of clients and stakeholders to determine the appropriate benefits on contingent events to be provided by financial products. All right. Again, I'll be asking ChatGPT for more content on this syllabus objective or topic. Right. Back to ChatGPT. I'm gonna add explain to an actuarial graduate who just entered the workforce. All right, so on meeting the needs of stakeholders. When you think about meeting the needs of stakeholders as an actuarial graduate, it helps to start from the idea of contingent events. These are uncertain events such as death, disability, illness, unemployment, or longevity that create financial strain when they occur, right? The core role of the financial system in this area is to transfer. The core role of the financial system in this area is to transfer, pool, or smooth the financial impact of these events across individuals. The core role of the financial system is the core role of the financial system in this area of meeting the needs of the stakeholders is to transfer, pool, or smooth the financial impact of these events across individuals, time, and institutions. In South Africa, the main providers of benefits linked to contingent events include the state, employers, insurers, retirement funds, and medical schemes. The state provides a baseline level of protection through social security and social assistance. Employers often provide group benefits such as retirement, death and disability cover, and private insurers and funds offer more tailored solutions. A key takeaway is that no single provider meets all needs. Instead, individuals' outcome. A key takeaway is that no single provider meets all needs. Instead, individuals' outcomes depend on how these providers interact, which is particularly important in a country with high inequality and uneven access to formal employment, right? So, social security benefits and private financial products are designed to respond to similar risk but operate in different ways. So, in South Africa, social assistance such as the old age grant, disability grant, and child support grant provides minimum income support funded from general taxation, with eligibility based largely on means testing rather than contributions. Social insurance arrangements such as the Unemployment Insurance Fund, that is the UIF, and the Road Accident Fund provide benefits linked to specific contingencies and prior participation, right? Alongside this, private financial products such as life insurance, disability income policies, medical scheme cover, and retirement annuities allow individuals and employers to purchase additional protection. So these products meet stakeholder needs by replacing income. These products meet stakeholder needs by replacing income, covering medical costs, or providing long-term financial security, often at higher levels than the state, but subject to affordability and access constraints. In practice, actuaries must understand how these layers interact. For example, when designing employer group life cover that sits on the top of UIF and state disability support. The design of these benefits and products is shaped by fundamental principles of insurance and pensions. The design of these benefits and products is shaped by fundamental principles of insurance and pensions. Insurance relies on risk pooling, where many policyholders contribute premiums so that the cost of claims for the few who experience a contingent event can be met. It also depends on the law of large numbers, underwriting, and the management of moral hazard and adverse selection. In pensions, key principles include long-term savings, compounding, intergenerational risk sharing, and the management of longevity risk. In a South African context, these principles show up clearly in practice. Medical schemes use community rating and prescribed minimum benefits to support solidarity, while retirement funds must balance investment risk and longevity risk in a volatile economic environment. So, one of the most important insights is that technical design choices such as benefit structures or contribution rates reflect trade-offs between fairness, affordability, and sustainability. Determining the appropriate benefits to provide requires careful analysis of these needs of the clients and stakeholders rather than simply applying standard products. This analysis starts with understanding the nature and the financial impact of the contingent event, the likelihood of occurrence, and who ultimately bears the risk. For example, when advising an employer on group disability benefits, an actuary would consider employees' level of income, existing state benefits, the employer's budget, and the potential reputational and labor relations impact of inadequate cover. In South Africa, this analysis is especially nuanced because of diverse workforce profiles, informal employment, and varying levels of financial resilience. So stakeholders' needs may differ significantly. Employers may prioritize income securities. Employees may prioritize income security. Employers may focus on cost predictability, and regulators may emphasize fairness and solvency. So in practice, actuaries use both quantitative and qualitative approaches to analyze these needs. Quantitatively, this might involve modeling income replacement ratios, projecting benefit cost under different economic scenarios, or stress testing outcomes under adverse experience. Qualitatively, it involves engaging with clients to understand their objectives, risk appetite, and social context. For instance, when advising trustees of a pension fund, an actuary must consider not only funding metrics but also members' likely behavior, such as early withdrawals under financial pressure, which is highly relevant in South Africa. The key takeaway for a new actuarial grade is that meeting stakeholder needs is not about finding a single correct answer, but it is about using actuarial tools and judgment to design benefits that are appropriate, balanced, and defensible in the real world of economics.